Good morning. Good morning. Good morning. Good morning. Hi, Abhishek, Gagpaliwar, Anirudh Sharma, Arun, Abhishek, Bijal, Dipali, Osla, Ishpuri, Jitendra Phule, Jitendra Joshi, welcome. Kamlesh Mehta, Kartikeyan, Kavita, Kishore, Mangesh, Nitin, Priya, Rahul, Rajesh, Rakesh, Rashmi, Santosh, Sangita, Srinivasa, Suchit, and Umesh. Hi, welcome everyone. So today we are going to start a new series for the next 5 days. Okay. We're going to talk about a completely, so last 2 weeks, we have been discussing inflation and we have discussed interest rates. All right. This week, we are going to get into the world of liquidity. All right. We are going to get into the world of liquidity. And it's going to be broken up into 5 parts: Monday, Tuesday, Wednesday, Thursday, and Friday. And we are going to go deeper into the world of liquidity. So today, we are going to start with the first part on liquidity. And today, it's going to be about what exactly is liquidity, how does one look into it, what are the various parts of it, and so on and so forth. Okay, perfect. Ready, everyone? Uh, Super, super. Okay. All right. Okay. So today it is about what is liquidity. Tomorrow we are going to cover RBI liquidity, like certain technical stuff. Then on day 3, we are going to get into liquidity and equity markets. Day 4, we are going to cover global liquidity and FII flows. And then day 5, we are going to see what is a dashboard that an MFD can create in order to understand what is really happening. Okay. And the way to look at this series this week on liquidity is understanding why markets move before fundamentals change. Okay. Because inflation tells you the pressure, interest rate tells you the cost of money, and liquidity tells you whether the markets have the fuel to run. Okay. Liquidity tells you whether the markets have got the fuel to run. All right. Super. Let's get started. Now, जब हम लोग मार्केट्स में लिक्विडिटी की बात करते हैं, लेट मी स्टार्ट विद अ क्वेश्चन. देखो, मार्केट्स का वैल्यूएशंस बहुत हाई है. ओके, फिर भी मार्केट ऊपर जा रहा है. हाउ मेनी ऑफ यू हैव एवर सेड दिस टू योरसेल्फ कि मार्केट का वैल्यूएशंस काफी स्ट्रेच्ड है, फिर भी बाजार ऊपर जा रहा है? How many of you have ever come across a situation like this? Right? Yes, in the chat box. Many times, Karthikeyan, कि valuations are stretched, फिर भी मार्केट ऊपर जा रहा है. और न्यूज इतनी नेगेटिव है, मार्केट गिर क्यों नहीं रहा है? There are so many bad news which is like hitting the market one after the other, but still the market is not falling. Okay. How many of you actually know where the money which pushes the market prices upward is coming from? Where does this money come from? Where does this money come from? Because this is where most investors, advisors, we get trapped. We think markets move because of good news. We think market moves because of GDP growth. We think market moves because of election outcomes, maybe, or maybe company results. Sometimes market prices rise despite terrible news. Let me tell you something which is possibly not discussed many times. And sometimes markets fall because of despite a good news. Why? Because markets don't move only on information. They move on one thing, which is liquidity. Let me give you an example that maybe we will be able to relate to. Suppose the price of houses falls by 10% versus your income has gone up by 10%. Which one has got a higher probability of pushing the demand? The price drop or the income growth or the liquidity growth? Your income goes up by 10%, so you have 10% more money in the bank versus price drop. Correct. It is the income. Now, this is one of the most misunderstood forces in finance. Liquidity is invisible. You cannot touch it. But it can quietly control the market momentum, the valuations, the investor aggression, the FIR behavior, and even it changes the way people's panic or greed. Can even the best car in the world move without fuel? Absolutely nothing, right? We know that. So how do people react? They react because we are looking at stocks on one side, we are looking at fundamentals on the other side, but the smart money looks at liquidity. The smart money looks at liquidity. When liquidity is abundant, markets can ignore bad news. They will just brush it aside. But when liquidity disappears, even strong businesses struggle to hold on to prices. So today's session is about understanding the hidden fuel behind market movement. Not any kind of headlines, not noise, but the actual force that drives risk-taking within the system. Because once you understand liquidity, you will stop asking, why is the market moving? Okay, ready? Everyone? Absolutely ready? Chaliye. Let us start. Let me just download my presentation deck and we will get started. Just give me 30 seconds. Just a minute. Yeah. Is it visible, all of you? Ready? Is the slide deck visible? All right. Thank you. So liquidity is the invisible fuel that drives the market. It is invisible. It cannot be touched, but it has to be felt. Okay. And let's get started. So markets routinely defy the daily market cycles. Have you ever watched that markets? We discussed this, right? So economy weak hua, war news, inflation's going up, global uncertainty, फिर भी starting to go up. The aggressive market rally amidst negative sentiment is many a times observed. And then there is the paradox of good news. Economy is booming, companies are delivering record profits, strong corporate results, but still the market prices starts to tumble because markets do not move on fundamentals alone. So the missing variable is liquidity. So there are three parts. The engine, the economic fundamentals. They represent the engine of the capability. Okay. ये चलेगा कि नहीं चलेगा. Then comes, the destination. How much movement are you expecting in the system? And liquidity determines if the vehicle is actually going to move today or it's going to wait for some more time before it starts to move. So liquidity dictates the ease of systemic money movement. High liquidity means easier borrowing, easier to invest, and more risk-taking ability. Tighter liquidity is tighter spending, lower investment appetite. And since it's tightened, it's going to lead to a cautious behavior amongst the clients. Liquidity is the absolute amount of money available in the system and the friction involved in moving it. Market environment is a product of two intersecting forces. Okay. One is the economic fundamentals, and other is the systemic liquidity. When the systemic liquidity is abundant, economic fundamentals is on the x-axis. Systematic liquidity is on the y-axis. When the systemic liquidity is abundant, okay, markets may still tend to go up. The engine is sputtering, but excess money must not go somewhere. But if the systemic liquidity is abundant and the economic fundamentals are strong, we are in an ideal bull market. Economic fundamentals are weak, systematic liquidity is tight, we are in a severe bear market. Okay. Now, fundamentals decide the direction of the long term. ये बहुत अच्छा sentence है. Fundamentals decide the direction over the long term. The liquidity decides the speed in the short term. ये चलेगा तो अब से कितना शुरू होगा और क्या स्पीड से बढ़ेगा. Systemic liquidity flows from four primary reserves. Okay. Number one, the central banks. Whether it's RBI in India or Federal Reserve in US, they are the people, they are the authorities who are injecting or withdrawing money from the system. That's the central bank. Second is the banking system, loan growth. Loan growth, more and more loan growing, that means more and more is moving, money is moving within the system, the velocity is going up, and the money multiplier will enable the money is expanding. 1 rupee can become 4 rupee by the end of the year, depending upon how fast the money is growing. Okay. Third, institutional flows. FIIs, ka bahar ka paisa. Domestic institution investor, how much of money they are just keeping in the bank or bringing into the market. And finally, the retail participation. These are the four big reservoirs of liquidity flows into the market. Okay, all of this money gets into the system, into the market. Abundant liquidity forces capital up the risk curve. Okay. Sometimes what I might find to be risky, sometimes if you give me too much of money into my hands, I might not consider it to be risky. Okay. So liquidity will take care of many people's fear. Valuations will expand, risk appetite will rise. Lower interest and global injections will all fuel this. Okay. And this shift, capital forcefully migrates people from FDs into equity. And people will move from safety towards growth. Because remember, bull markets often begin just when the liquidity starts to become abundant. In 2020-21, we had seen a golden period of abundant liquidity within the system. Tightening liquidity indiscriminately compresses the valuations. Central banks tighten aggressively, borrowing slows down, valuations compress, and risk appetite also falls. The impact is that money becomes highly selective. किसके पीछे जाएंगे, कौन से स्टॉक में इन्वेस्ट करेंगे, they become very, very selective. Speculative assets and technology stocks crash. Volatility increases. Markets don't crash only because news is bad. They crash when liquidity disappears. Remember, liquidity changes the behavior much before it changes the headlines. Market movements is a self-reinforcing cycle. Participation booms, excess money enters. Excess money moves into asset prices. Asset prices starts to rise. And all of that leads to confidence going higher and higher. Okay. Prices don't create liquidity. The liquidity decides the behavior. Okay. So the stance, what is the RBI stance? Whether it is aggressive or dovish. What's the US Federal stuff? Where are the bond yields, the banking liquidity, and finally the FII flows? The strong fundamentals without liquidity will always struggle to gain traction. Just a second. Saying market sentiment अच्छा है या market expensive लग रहा है या correction आ सकता है. Always bring in words which elevates your conversation and places you from a position of authority. Start saying liquidity conditions are supportive. Excess liquidity is expanding valuations. Liquidity tightening may put some pressure on risk assets. Momentum requires both psychological and systemic liquidity. It's a mix of both belief plus money, which creates momentum. Momentum requires both of them. Okay. Belief alone is not enough. Without the invisible fuel of liquidity, even the most optimistic markets will struggle to sustain the momentum. News moves emotions. Liquidity moves the market. All the best, everyone. Have a great day ahead. And see you tomorrow exactly at 10:10. And we will move ahead into the next part of this session. All the best. Have a great day ahead. Thank you. See you tomorrow.